I don't think it's surprising that the last so-called hurdle of defeating inflation as being the toughest one to clear. I think that was kind of expected from investors as a whole, but certainly from the Fed, and we're seeing that the stickier components to inflation, particularly in relations to shelter prices, has been difficult. But overall, when you look at when you start annualizing the core inflation numbers, we do continue to trend lower and lower, and it's a promising trend, but it's taking a while. It's taking some time to get to where the Fed's trying to go.
Hi, and welcome to Wealthion. I'm James Conner. My guest today is Bret Kenwell, and Bret is an investment and options analyst at trading and investment platform eToro. Bret, thank you very much for joining us today. How are things in the great state of Michigan?
Things are great. Summer's in full bloom, and we're soaking up the sunshine while we can.
So I am located in Toronto. You and I are like neighbors.
Just about, just about.
I'm going to have to come down there and watch a Detroit Lions game. They had an incredible year, so I'm looking forward to seeing how they do in the upcoming football season.
Yeah, likewise. We big thing to cheer for this year.
So let's talk about the markets. The S&P and the NASDAQ have been trading at or near all-time highs. We have seen a little bit of volatility here in the last couple of weeks, a lot of it based on headline news, and a big driver of the volatility is politics, but also earnings. And we are in the thick of Q2 earnings season. We have 25% of the S&P reporting earnings this week alone. And last week, we saw a lot of the banks report, both JP Morgan, Goldman Sachs, Morgan Stanley, and others. And I want to get your thoughts on these U.S. banks. What's your takeaway here? Any concerns when you saw or read the press releases or heard the commentary?
Not so much. At the banks, the numbers were pretty solid. The rhetoric from the banks can be kind of cautious at times, and particularly from JP Morgan, we typically hear a more cautious tone from the top as it relates to the macro picture. And to Jamie Dimon's credit, the macro picture, it has been muddy for a while, and I think it does remain kind of muddy, but the positives continue to outshine the negatives. And, that's what we've seen so far, year to date in terms of the equity markets. Earnings season, it's still pretty early into it, but things are about to pick up here. Like you mentioned, 25% of the S&P is set to report this week. And once we hear from mega cap tech, I think that's going to be, really be a driver for how markets trade going into August.
And when you look at the banks, any concerns about the health of the U.S. consumer?
Not necessarily with the banks, but more collectively, I think over the last few months, we've seen a softening in the consumer. We've seen a softening in the labor market, and I wouldn't say it's outright weakness. I wouldn't go that step yet, but it's certainly hard to argue that things haven't softened a bit, and that's true whether you're looking at jobs, whether you're looking at spending. And I do think that is a consideration for not only investors, but for the Fed as well.
And what about real estate? Because I'm reading more and more about how there's various pockets in the U.S. where they're experiencing a lot of weakness. And I'm thinking about Austin, Texas, and also pockets throughout Florida. A lot of supply coming onto the marketplace, and there's no buyers. Any thoughts on that, or did you see or read any commentary from any of the banks about excessive loan loss provisions associated with real estate?
Right. So the real estate picture is pretty complex, I'd say. I'm not a real estate expert or a real estate analyst, but it's a complicated situation when you look at not only by region to region, but the different types of real estate as well. Commercial real estate obviously being the big concern for banks, generally speaking, and for a lot of investors. And even by banks, it varies a lot, whether we're talking about a smaller regional bank or a large commercial lender. So there's a lot of different variables to consider on the real estate front. And I'd say there's still certainly some concerns there. But so far we haven't, those concerns haven't come home to roost yet, I guess is how I'd put it.
And what about when you look at the broader indices, the S&P and the NASDAQ, they are at or near all-time highs. Any concerns about valuations, especially within the AI sector?
Like real estate, AI has quite a few different variables in there in terms of the quality of the companies. When you look at certain names within the space, um, I'll reference Nvidia just to address the elephant in the room. But when you look at Nvidia, yes, the stock has had an enormous appreciation over the last 1 to 2 years. But when you look at the underlying fundamentals within the company, on an earnings basis, free cash flow basis, margins, revenue, you look across the board, the company has seen an enormous acceleration, and that's as you know we have mega cap tech companies pouring resources into these applications, into the computing power to generate these AI applications, and so far that's keeping the trend alive and keeping the drivers firing on all cylinders. I think that probably continues for a while. I mean, at some point, supply will catch up with demand, and that will put a little bit of pressure on margins. But for now, I think a lot of people have kind of drawn conclusions between today's market and the 2000s and the dot-com bubble. Um, I don't think those comparisons are necessarily fair, with the reasoning being that the fundamental drivers are in place for AI, and there is quite a bit of excitement and hype with it, but there's also there's sustained business below that trend. So, when you kind of factor that in, yes, it's been a driver for the indices overall. As you mentioned, they've done very well, recently hitting all-time highs this month, and earlier at those highs, I think they're up about 20% on the year. NASDAQ was a little higher than that, but when you look at that kind of return, it's obviously an abnormal return. You don't typically see those large of gains in 6 months. And if we go off the October low, which was only 9 months ago, those gains are even more pronounced. So I do think we could be due for a little bit of a rest here, and a pullback would be normal. I think investors need to remember it's normal. It's average to get. I think since over the last 50 years, the S&P has averaged 3 corrections of 5% or more. So it would be very normal price action, be very healthy price action to have a month or two where, where stocks slow down a little bit, but overall the bull remains intact, the trends remain intact, and that's good for long-term investors.
So I want to get your thoughts on the economy now, because it's often said that the stock market is not the economy. So in spite of how well the stock market is doing, we're seeing weakness throughout the economy, and we saw a weaker Q1 GDP number. It was also revised down from 1.6 down to 1.3. We have a Q2 number coming out, I believe, sometime this week. What are your thoughts on the U.S. economy, and do you have any thoughts on this GDP number that'll be coming out?
This is where things can get a little bit tricky, particularly for the Fed. And we'll probably touch on rates in a little bit, so I'll save some of that for then. But the Fed is trying to balance keeping its policy restrictive enough to bring down inflation, but not so restrictive it pushes us into a recession. And you know, throughout this whole phase of having this higher for longer interest rate environment, the U.S. economy has continued to chug along pretty well. Q3 and Q4 were very strong last year, but then, like you mentioned, Q1 came in first. It came in weak, then it was revised lower, then it just came in very. It was growth, but it was not impressive. The estimates for Q2 stand around around 1.9%, depending on you know what forecast you're looking at. But generally speaking, the growth is just considered mild. It's not wowing anyone, but it's maybe not concerning anyone yet. I think when you look at the last few months of data, though, it's really important for investors to remember that 70% of the U.S. economy is driven by consumer spending. The consumer is incredibly important to the U.S. economy, and because of that, the labor market is incredibly important to the U.S. economy. And that might seem like common sense, but that's not necessarily the case all the time. But in the U.S., that is the case. And so when you start to see, retail sales come in light, when you start to see payroll numbers come in a little lower, unemployment rate tick up, jobless claims, come in ahead of expectations, you start to see some of those, and you ask yourself, is the consumer okay? Is the economy going to be okay? And unfortunately, these things take a little while to work through the system, and it kind of has a lagging effect, a lagging indicator on how the economy is doing. But yeah, I'd say it's I like we kind of said at the top of the show, it's softening. I wouldn't say it's weak, but these are all factors investors should certainly be taking into account when it comes to not only stocks but how they're allocating money and what the Fed might do later this year.
So yeah, you raise a very good point because the consumer in the U.S. very important. They represent 70% of GDP. So whatever the consumer does has a massive impact on the economy. And I just want to bring up one fact. Back in Q1, both Starbucks and McDonald's came out, and many other companies came out and said consumers just were not spending as much money in their stores or the restaurants. And it's going to be interesting to see what both Starbucks and McDonald's and the other restaurant companies have to say for Q2. But what are your thoughts on the U.S. consumer here? Do you see any other concerns in terms of spending or lack of spending?
I would just say in some of those cases, I think I think some of those issues can be company specific, without a question. But on the other hand, when you start to see it collectively at more than one, it's not just one or two companies we're hearing this from. We're hearing it from a lot of consumer based companies. And so, I would say the consumer is flexible. They can handle a little bit of price increase and certainly welcome price decreases. But when they look at higher prices at the pump, when they see higher prices at the restaurants, when they see at the grocery store, all these different areas, they're flexible, but the consumer is not a world-class gymnast. They can't bend over backwards at any price hike. And so at certain points, these companies are realizing that there will be backlash and there will be pushback from their customers. And we're seeing them respond, I'd say in many cases appropriately by, innovating their offerings and trying to get lower priced options in front of the consumer to get those customers back in the door. But yeah, generally speaking, a softening in consumer spending is a concern for the broader economy as a whole. But so far, they're holding together, but they're certainly off the highs.
Yeah, I'm still waiting for this $5 meal plan from McDonald's. I haven't seen it yet in Toronto. What about in Michigan?
You know what? Honestly, I haven't seen it either, but I'm also I'm not a big McDonald's guy, so maybe it's here.
So let's talk about inflation because this has been another big concern, and oil's been hanging around between $70 to $80 a barrel here in the past year, and I'm really surprised it's staying this low. But what are your thoughts on inflation, and maybe you can also touch on the oil price and where you think it might be going?
Yeah, inflation I don't think it's surprising that the last so-called hurdle of defeating inflation as being the toughest one to clear. I think that was kind of expected from investors as a whole, but certainly from the Fed, and we're seeing that the stickier components to inflation, particularly in relations to shelter prices, has been difficult. But overall, when you look at when you start annualizing the core inflation numbers, we do continue to trend lower and lower, and it's a promising trend, but it's taking a while. It's taking some time to get to where the Fed's trying to go. The Fed, of course, is trying to shoot for that 2% target. In my mind, I kind of think that the target is not a moving target, but it's not necessarily critical. I don't know if that's the right way to put it, but I think back to over the last 10 years, there was points where we had trouble getting up to a 2% inflation target, and things continued to move along nicely for the U.S. And well, I mean that economically and in regards to the equity markets. And so if we come down and if we're at 2.5 or 2.25, I don't know that that's so bad necessarily, as long as I'd rather have slightly higher inflation than what the Fed's targeting and have an economy that continues to do well versus getting to target, but doing so at by sacrificing the economy.
So the Fed has been trying to fight inflation with higher interest rates, and the Fed has they last increased interest rates in July of 2023. It's hard to believe it's been a year, but they haven't done anything since then. And when we started out 2024, we were talking about 6 cuts, and then it went down to 4 cuts and 2 cuts, and now I think we might be looking for 1 cut between now and the end of the year. But we have another Fed meeting coming up at the end of the month on July the 31st. What are your thoughts? Do they do anything then?
I don't think they cut, and I say that mostly because Chairman Powell and the Fed as a whole has been pretty transparent. The committee telegraphs what it's going to do for the most part. Obviously, they're open to changing their mind, and they can revise their outlooks and everything like that. But we get the dot plot 4 times a year, and in between the meetings in between, and just generally when the Fed members are speaking in a public setting, they telegraph pretty well, what their thoughts are, what the committee's thinking, and I don't expect to be surprised by the meeting in July. I do think they could set the stage for a cut in September, which at this rate is the consensus for a 25 basis point cut then. But I don't expect them to go early and cut in July.
Interesting. Okay. So your firm, eToro, does a lot in the cryptocurrency space. So I want to get your views on two cryptos. First on Bitcoin. It's been, I guess you could say, consolidating here in the last couple of months. Ever since the halving process, it really hasn't done much. What are your thoughts on Bitcoin, and is it going to take off as we go into year end?
I think you said it well. I think it continues to consolidate. We look at the move not only from last fall or year over year, which has been a tremendous rally in Bitcoin, but even off the lows this year. Coming into 2024, the expectation was we would get Bitcoin ETFs. We got them in early January. Bitcoin rallied into that event. They did the typical sell the news reaction, a nice healthy pullback, and then Bitcoin almost doubled, rallied like 90% to its highs in early March. And since then, we've just seen a consolidation. I think that's great. Might be frustrating for longer term holders, might be frustrating for bulls, but at the end of the day, consolidation after a big rally, that's great stuff. If it resolves up through the highs and if the fundamentals remain intact, then we could be definitely looking at higher prices for Bitcoin.
But where do you see the price going here between now and year end?
Man, honestly, I've never been good with targets, so I'm not going to venture out on this one. At some point, I'd love to see six figures on Bitcoin. I don't know if it happens this year, but plenty of people think it will. So we'll see.
No, I asked because I thought your firm would have a target price on it.
Oh no, internally we don't set targets, so not the
Okay, so
case.
the other big news in the crypto space is Ethereum. Why don't you tell us about that? What's the news?
Yeah. So in May, expectations were pretty low that the SEC was going to give the green light for Ethereum. They surprised the market. They warmed up to it. They set the stage for approval sometime this summer. That approval process is complete now, and now we look forward to the trading of, I believe it is 8 Ethereum ETFs will hit the market. eToro has always offered Ethereum, the coin, the cryptocurrency, just like Bitcoin, and like the Bitcoin ETFs will offer the Ethereum ETFs. But generally speaking, I think it's a good thing. I think it was a good thing for Bitcoin when they got their ETFs. And I think it's a good thing for Ethereum. Anytime an asset class has the potential for, I mean, an asset's price is driven by supply and demand. So anytime that the market can find a way to increase demand, and in this case by offering the Ethereum ETFs, gives another way for investors to buy Ethereum that may not be so comfortable going out and buying the actual cryptocurrency, but they feel a lot more comfortable with an ETF, a product that they're familiar with and have used before. It just gives another chance for more demand, gives a chance for more price appreciation. I think it's a positive for the industry as a whole and for investors as a whole.
And Brett, maybe you can give us a background or explain the difference for those viewers who might not be too familiar with the whole crypto space. But what is the difference between Bitcoin and Ethereum, and why would I invest in one versus the other?
Ethereum tends to have more applications than Bitcoin, and Bitcoin, by many people, is considered a store of value. But the way I would look at it is Ethereum tends to be the number two to Bitcoin, and that's just the way it goes. Bitcoin is by far the most popular cryptocurrency, and it's the most well recognized one. And for me, I think those two will probably move not necessarily in lockstep in terms of percentages, but I think they would move in lockstep in terms of direction. And at certain times, Bitcoin outpaces Ethereum. In other cases, it's vice versa. But Me personally, I do like to go with the names that are more that have larger market caps, have more market recognition, and even though they might not have some of the explosion that the some of the smaller, cryptocurrencies have, and I'm not a cryptocurrency expert, so I don't typically get into the smaller coin situation. And I know people make great cases for them, but I like names that have large liquidity, large recognition, and large market cap. So those are the top two for me.
So, Brett, you are an options analyst at eToro. Why don't we talk about options now? What are you seeing in the space? Where's all the activity going? What sectors or what names?
The AI trade has been red hot. Of course, generally speaking, there's still a lot of action in the 0 days, as it relates mostly to the S&P. But short dated options and AI related options there's been immense flows there all year long. Not to stick with Nvidia, for the whole show, we mentioned it earlier, but the flows we've seen in Nvidia have been robust this year, and I don't know that slows too much, at least until some of these trends slow down. But for now, the institutions love using options for some of these mega cap names for these AI plays, and it makes sense why. Options are very versatile, and it gives, especially for larger institutions, larger players, it gives them a different way to sort of structure their exposure. And we've seen the same thing now more recently in small caps as it relates to the Russell and to IWM, things of that nature. It's a great way for institutions to have a lot of liquidity and a big way to get exposure, leveraged exposure, to a new trend, to a new space, without necessarily having the same risks that come with common stock exposure or futures exposure.
And I got to ask you about Roaring Kitty because he came back to life about a month ago. I'm not sure if you watched that live stream. I was on there and couldn't believe it. There was like 600,000 people on live watching that guy.
That was crazy.
But are you seeing any activity in GameStop or his new name, Chewy?
You know, um, Off the bat, when it was especially GameStop, my goodness, that whole saga came. It was like flashbacks from 2020, 2021 just came roaring back. No pun intended, came roaring back. But yeah, there was a lot of flow, a lot of action in the GameStop options. But I think a lot of investors, particularly on the retail side, kind of, I don't want to say learn their lesson, but sort of, learn their lesson from the last go around a few years ago, and kind of knew how things would end, and maybe we have a resurgence sometime later this year. But these events are becoming shorter and shorter lived, and I think that's probably the healthiest thing for it to do.
Brett, as we wrap up, what should investors be aware of in the coming days and weeks? Maybe you can just highlight earnings that are coming out or economic data.
Yeah. So, speaking of the most immediate, the most short term, in the next not even 10 days, we have the Q2 GDP report, the monthly PCE report, which is the Fed's preferred inflation gauge. And then we hear from the Fed at the end of the month. The 30th and 31st is the 2-day meeting with the press conference on the 31st. So, economically, there's kind of a lot there to work with. But we also are trying to navigate, the busiest 2-week stretch of earnings, where we're going to hear from most of the mega cap names. Essentially, we'll have, by the end of these next few weeks, by the end of August 2nd, the week ending August 2nd, we'll have heard from all of the mega caps with the exception of Nvidia, which will be later on in the season. But getting through these next few weeks, I think, will define how equities can trade going forward. We've had a great start year to date. The backdrop remains promising. It's easy to look at all of the risks out there. It's easy to look at some of the rhetoric, whether that is inflation driven, valuation driven, expectations that we've rallied. We rallied 20% year to date at one point. We can't, the idea we can't keep going. Well, we have a lot of positives going for us at the moment. We just came off the S&P came off its best quarter of earnings in 2 years. And now Q2 and Q3 are set to accelerate up towards the high single digits, around 8 to 9% earnings growth year over year for both quarters. And then beyond that, the next 4 quarters are expected to accelerate to double digit growth. So The earnings backdrop is there. We're approaching a scenario where the Fed is likely to cut rates here in September. Obviously, that can be a fluid situation, but the idea with rate cuts is that it's a when, not if situation. So when you look at the two together, and I think of it like this is how I try to look at things, I try to boil it down into a simple manner. There's a lot of factors that matter, but earnings and fiscal policy are two big ones when it comes to the US stock market. And if we have an easing Fed and we have better than expected earnings growth, those are very good recipes for a continued bull market. So seasonally speaking, it's a bumpy couple of weeks and it's a bumpy couple of months. August and September do not tend to be easy months. Or same with October. They don't tend to be easy for bulls. It tends to be a choppy, seasonally bumpy part of the year, but that can be good for long-term investors. It's normal to have corrections, normal to have pullbacks. And as long as the fundamental backdrop remains in place, I think that's an opportunity.
Yeah, we got a lot to look forward to in the next couple of weeks. And you didn't even mention the Olympics. They're starting up soon.
We do have the Olympics starting up soon. That'll be fun.
Well, Brett, that was a great overview. If someone would like to learn more about you or follow your insights on the markets and learn more about eToro, where can they go?
You can just find me on Twitter or X, whatever you prefer to call it. It's just my name, Bret Kenwell, and same with LinkedIn.
That's great. Once again, thank you.
Thanks for having me, James. Look forward to talking to you again.
Well, I'm sure you would agree with me when I say we are living through some crazy times right now. And every day there's a new headline which is creating havoc within the financial markets. And to maneuver through these markets requires a lot of skill and knowledge. And if you need help planning for your financial future and also managing your investments, consider having a discussion with a Wealthion endorsed financial advisor at wealthion.com. Simply provide some basic information to Wealthion and they will put you in touch with a vetted advisor. Once again, you can find out more information at wealthion.com. I want to thank you very much for spending time with us today, and I look forward to seeing you again soon.